It was curious to me that this past week, the media, I don't think I saw it. I mean, I picked it up in a small article that the deal, the agreement that the U.S. made with Saudi Arabia, the petrodollar deal that's been in place for the last 50 years, expired last Sunday. And that pretty much kills the petrodollar and has got tons of implications, and I'll uncover that. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is June 25th, 2024. Before I get into this petrodollar thing, I wanted to say something that I don't know if you saw this or not, but it was in a small article that 45% of U.S. owners of EV vehicles, electric vehicles, are turning them back in, handing back the keys and saying, I don't want it. I don't know if they're going backwards or default on the loan or sell them. I don't know what they're doing, but they're not keeping the cars. Worldwide, that number is 50%. Why? The infrastructure to support EV vehicles is not there, and the cost is much higher than they were expecting. So that is adding to the problem. The supply-demand equation is still going backwards, and people commented on that video that I did. A lot of people did, and I'm just saying that if this is the future, if EV is the future, then we should all want it. It should be a good deal. But if it's being forced on us, you have to own this, you must own this, we have an agenda for you to own this, and it's not a good deal, people don't want it. You know, I'm driving my old truck, I'm happy with it. Sure, I'd be happy with a new truck, but I don't want to pay the money to get a new truck, and it's just a rolling computer. So I don't have that with an older truck. But when you look at the cost of trucks, I mean, trucks are probably 60 to 100,000. You can get them over 100 and you can get them for less than 60, but I would say the mean is about 80. On cars, I think it's less than that. It's probably 40 to 50,000. But when people go to, and people don't, most people don't have that kind of money to just go buy one for cash. Some people do, but most don't. So they finance it. So you're subject to these higher interest rates and cars that turn out to be very expensive to operate. And so it's a dilemma. I think that the new car market particularly, I don't know that it goes into the used car market, but the new car market is in terrible condition, and for all the reasons I just stated. So I thought I would add that up front. A week ago, Sunday, was the expiration of the deal that we signed with Saudi Arabia, the U.S. signed with Saudi Arabia, and it's known as the petrodollar. Now, you have heard, probably, some of you may know a lot about it, but most people have heard about it, but they don't know a lot about it. So I thought I would tell you what the deal was that we made, and then explain where it is today, and then the implications. Going all the way back, before it started in 1974, and that followed 1 year following the gas oil crisis of 1973, when there were lines around the block waiting to get in to get whatever gasoline they could get. But when you go all the way back to 1944, the Bretton Woods, New Hampshire Accord, where 44 nations sat around a table and agreed that the U.S. would be the reserve currency of the world. That followed a very long period of time where the British pound sterling was the reserve currency of the world. So we replaced that in 1944. The deal was that we had to agree to back that currency with gold. In other words, the paper of a dollar was backed by actual gold. And at that time, as I recall, we had 16,000 tons of gold in Fort Knox and in the Federal Reserve Bank in New York, and perhaps some other locations. After the war, sometime after the war, we were buying goods from Europe, the Netherlands, France, Germany, Italy, etc. And they were piling up with dollars. And so here we have this agreement that we will exchange. Basically, it's an exchange of paper dollars for gold. Well, they're not stupid. So at some point, I know it happened in the early 70s, but I think it probably happened before that, they were sending ships to America full of dollars. And what they wanted was to exchange that. And they got it. We gave it to them. We had to. It was our agreement. We gave them, sold them gold in exchange for those dollars. And these were a large amount of dollars. They depleted, we honored the agreement. That's the deal we made. They depleted the gold reserves in Fort Knox and the New York Federal Reserve Bank. They depleted those reserves from 16,000 tons down to 8,000 tons. Our gold went down in half. The only thing that backs our currency that has intrinsic value is the gold that we have in those places. Nixon, in his infinite wisdom, signed an executive order and said, we're going to break the agreement. We're not going to honor those. You can send the ships back. I don't care how many dollars they have. We're not going to give you any gold. And thankfully, he did that, because our vaults would have been emptied very quickly. So we did preserve 8,000 tons. That's at least what the official word is. Hopefully it's there. And then you come to the oil crisis in 1973, and if you were around then, many of you were, you remember the lines at the gas station to get your gas. And then we made this deal in 1974 with the Saudis that, and this all relates to all the way back to the gold and the Bretton Woods Accord. At that time, we said, okay, we will back you, Saudi Arabia, we will back you militarily. We will give you protection if you will sell all of your oil in dollars, denominated in dollars, and any excess or any profits or revenue that comes out of that, you will use that to buy U.S. treasuries. So you get military protection, which they did not have, and we will get stability of our currency, we'll get our treasuries will be propped up, and so forth. So we agreed to that, and they honored it, and we honored it. So they became, at that point, a really good partner with us, a financial partner, an energy partner, and what that did was, the effect of that, and this is literally 50 years ago, from 1974 to today, what happened was that it stabilized our currency. Our bond prices went up because they're buying bonds. More dollars are flowing into bonds than are flowing out. And it stabilized the price of oil, kept the price of oil down. And it supported what we originally agreed upon in 1944, which was supported the notion that the US dollar is the reserve currency of the world. So now we get to 2024 and the deal expires. Well, in June of 2024, somebody didn't just wake up and think, oh gosh, I forgot, we've got this agreement that's expiring with Saudi Arabia that's supporting our currency and our treasuries. No, they knew a long time before today. What have they done? I don't know. That's probably secret and confidential. But the I would say that I would not say maybe the dollar, the petrodollar is dead, but unless something happens that has not yet happened, it is dead. And what could happen is they could renegotiate the deal, but now we're negotiating. This is a very different picture today. We're negotiating from a position of weakness, not strength. And the countries have already started dealing with Saudi Arabia in their own currency, including the yuan and the ruble and so forth, have been dealing with them, buying oil in their own currencies. That's already been happening. Now the BRICS nations, Brazil, Russia, India, China, South Africa, they've now band together, called the BRICS nations. They band together and they are pressuring Saudi Arabia, the way I read it, to sell them oil in their currencies. Now, in addition to that, and you'll hear this in this video clip I show you, that there are 40 more nations that want to be in with the 5. So now you got 45. I guess Argentina bailed out. So, okay, you've got 44 nations that want to be part of this deal, bypassing the US dollar, bypassing the deal, the petrodollar, just dealing with Saudi Arabia directly. Our relationship maybe has gone a little south. I don't know enough to say that for sure. But Saudi Arabia is tempted, and maybe they're doing it. Seems like they are, that they're actually negotiating with other countries in their currencies. So this is bad for the U.S. Treasuries. It's bad for the U.S. It's bad for our economy. It's bad for the price of oil. Now, this won't happen tomorrow, probably. I shouldn't say for sure, but probably won't happen tomorrow. But over time, there's going to be a diminishing of things that matter to us, including the things I just said. So this is a piece that kind of explains it in pretty good terms. This is a blogger. It's about 3 minutes. I thought he did a pretty good job. And you can listen to that and see what you think. Where do we go from here? I'd say we need to think, we were energy independent. We need to get back to energy independence, in my opinion, because this is going to drive up the price of oil big time. Secondly, the other thing that's happening here, remember traditional investment portfolios, 60-40 portfolios. What is the 40? The 40 is bonds. Usually, it's government bonds. So if they're not buying bonds, the supply and demand is going to go backwards, and that's going to be devastating for the U.S. Treasury bond. So it's not good for traditional portfolios, and it's just not good for our economy. So what can you do about it? Not any more than I can, other than I want to make you aware of it, because I've talked to a number of people who were not aware that this happened. So you can Google it if you want. You can Google Petrodollar, etc. So this is a blog. This is just a few minutes of a blog that I thought was pretty good, that explained it, and you can listen to this from here.
Is Saudi Arabia moving away from the United States? My friends, over the course of this week, we have experienced something that potentially could be massive. The established financial world order of the past 50 years is now transitioning to something that is unknown, a kind of new paradigm, as the Petrodollar agreement between the United States and Saudi Arabia was allowed to expire here this past week. For a number of people that are watching this right now, they may be a bit confused. The term petrodollar is something that describes the US dollar, the USD's role as a currency that is used for crude oil transactions on the world market. This is something that traces back to the early 1970s, when the United States and Saudi Arabia would strike a deal shortly after the United States went off the gold standard. And that agreement, for at least the past 50 years, is something that has had far-reaching consequences for the global economy. Not necessarily negative things per se when I say consequences, but it has certainly been far-reaching. We are going to go into more detail about this, but the petrodollar agreement came about following the 1973 oil crisis. Essentially, Additionally, this would stipulate that Saudi Arabia would price its oil exports exclusively in US dollars, and it would invest its surplus oil reserves in US Treasury bonds. In exchange, the United States would provide military support and protection to the kingdom. This is something that would help the US dollar cement its position as the world's reserve currency, and it would usher in an era of prosperity for Americans as they enjoyed the benefits of being the preferred market of global corporations to try and sell their wares. In addition, the inflow of foreign capital into US Treasury bonds would go and support low interest rates and a robust bond market. But now it seems that all of that is set to change as Saudi Arabia is looking to move beyond its more exclusive relationship with the United States. This being evidenced by the kingdom becoming one of the newest members of the BRICS bloc, which I will say this right now, that is probably something for geopolitical history that we are going to need to cover in detail here soon. For those who are uninitiated, BRICS is an acronym for Brazil, Russia, India, China, and South Africa. The BRICS countries operate as an organization that seeks to further economic cooperation amongst member nations and increase their economic and political standing in the world. In other words, besides the more complex language that I could use to describe this, BRICS is something that sees itself as countering the traditional Western-led global order, with some member states viewing this organization as a way to boost their influence and remove their dependency upon Western financial institutions. Because of their economic power and the appeal of trying to disentangle from the West to a degree, BRICS claims over 40 countries are seeking to join the group, with an announcement going out in their 2023 summit that several nations were set to join them as full members. Full membership was supposed to be granted to Argentina, Ethiopia, Iran, Saudi Arabia, Egypt, and the United Arab Emirates on January 1st, 2024, but this agreement would not fully go through as Argentina under President Milei would end up pulling out of this deal. The rest of them would join this though, and that in and of itself is something that brings us back to Saudi Arabia. Because now, my friends, Saudi Arabia is now set to sell oil in multiple currencies, including the euro, Chinese yuan, yen, other things that are, well, different. I really don't know what else other word I could use to even describe this here in the first place. Essentially, not just the US dollar. If you go and look up the news about this particular subject, even the fact that I am talking about this right now, many people who watch oil and geopolitics report that this is a major shift in global energy trade and in economic power from the United States to more emerging countries in the global south.
Okay, next is a piece by interview that Adam Taggart does with a guy named Fred Hickey, and he has been around for 45 years. He writes a blog, it used to be a newsletter called The High Tech Strategist, and he's actually very good. He's got good insight on the economy as well as on the market. So as I listened to him, I realized he says a lot in just a few minutes. So I want to play that for you, and basically his premise is that things are not wonderful for most people. So we hear one side that says, okay, the market is going up and up and up, and it is. And there are elements of the economy that are going up. There's AI, which is going to the moon. But there are elements of the economy, most of the economy, Main Street economy, and the average person, they're struggling. It's not roses. And so the bubble that's out there that where things people are doing well is the wealthy, the 1% or the 1/10 of 1% or whatever that are doing well, while a lot of people, the vast majority, are struggling. Anyway, he goes into some detail and explains that. So take a listen to Fred Hickey.
What's your current assessment of the global economy and financial markets?
Well, starting with the economy, I think globally it's relatively weak. The U.S. has the strongest economy, and it's a pretty mixed picture there. If you look at China, they just had results out today for production and retail sales and housing, and their housing prices fell, existing home prices fell 7.5%, which is a terrible number. And their industrial production was weaker than expected, and retail sales were soft. And that's the second largest economy in the world. You know, Europe has problems. We'll see what happens with the French election coming up shortly. But there's a lot of issues there. They've been in and out of Germany, particularly in and out of recession. Japan has been in and out of recession, barely growing at all. And then you have the U.S. And the U.S., if you look at it, the high-end Americans are doing well, mostly because of stock market wealth and real estate wealth. And the rest, those who do not own those assets, are doing relatively poorly. So I saw a statistic that said that 60% of households with four people in it are struggling financially. Those are with 60,000 income and up, and they're struggling financially. That's a large number of people. If you look at retail sales, they've been weak. But if you inflation adjust those retail sales, they're negative. About the only major retailer that's doing well is Walmart, and they're seeing a big shift in their sales from groceries, which half their sales, to groceries and healthcare from other areas such as discretionary electronics spending. Target's terrible, Kohl's terrible, Home Depot, they're all awful. If you look at the jobs picture, it's somewhat mixed, but I think it's pretty terrible. Only because I don't trust the payroll survey, which came out with just this latest number, a better than expected number of about 270,000 added jobs, but almost all of those, 90%, were from the birth-death model. And the birth-death model is just a computer model that's wrong at turning points in the economy, because it's they just make they make guesses as to what small and new businesses are doing, and at market turns, they're always wrong. If you looked at the household survey, you saw a 600,000 drop in full-time jobs, an increase in part-time jobs because people are taking on 2 jobs. We've seen the JOLT survey. We've seen those job openings drop from 11 million to 8 million openings. So from a jobs perspective, it's not great either. There's definitely a slowing going on there. The unemployment rate has risen from 3.4% to 4%. And when that happens, when you get a 0.6% increase, that usually precedes recessions. Industrial production, weak. 18 of the last 19 months, the ISM has been in contraction. Orders and backlogs are 45 and 42, and 50 is the dividing line. Real estate, obviously the housing market is very poor. It's mostly, you could say it's in the doldrums, it's frozen. People can't afford homes, young people particularly. So the average income required to buy the median home is 115,000, but the average income is only 75. So you have the worst affordability since the 1980s, when Volcker had lifted interest rates tremendously. So the only area that we really have strength is in experiences and going to sporting events and Taylor Swift concerts and traveling to Europe for the summer vacations, and that's from the high-end people, where we've seen huge amounts of wealth that have been created by mostly the stock market, but also in the real estate market. And over the last 4 years, that's up. Household wealth is up to $160 trillion, and it's up 45%. But it's all in the high end. So it's a very bifurcated economy here in the U.S. And what that tells you then is that the part of the economy that's still doing well is dependent upon high asset prices. And if those asset prices fall, then nothing's going right. And eventually here, asset prices will fall, because last time we talked in November, they were insane, and now they're ridiculously insane. Herb Stein said, if something cannot go on forever, it will stop. I don't know when this bubble will break. I think it's the greatest bubble I've ever seen. And I've been an active investor for 45 years, so I've seen some. When you see, you had some statistics that you had thrown out earlier, but NVIDIA went up $1 trillion in 1 month. Okay. Apple's gone up $700 billion in 6 weeks. Apple does not have good numbers. Their latest report was a decline in revenues. It was the 5th decline in the last 6 quarters. They had negative net income. Their iPhone sales dropped 10%. their international sales were down 6%. This is not a justification for a $700 billion increase.
And then finally, I want to play a piece from David McAlvany, and I love listening to him. And if you don't subscribe to the McAlvany Weekly Commentary, you can give it a listen. This one was a short one. It was about 30 minutes long, but sometimes they're an hour or a little more than an hour. Sometimes he has guests and sometimes he doesn't, but he's always very thoughtful. And this piece that came out this past Wednesday, he talks about the fact that there are, just like we've been talking about, there are elements of the economy that are not doing very well. And he said that he worked for, this is back before he left Wall Street, he was worked for Morgan Stanley, and he left, and then he goes on to talk about a major firm, and this is more recent, a major firm has now said, and I'm going to paraphrase, you can listen to McAlvany say it, but he says that basically this firm, major firm, so if he didn't say the name, he didn't want to do that, but if he said the name, we would probably all recognize it. And they said what they're doing is they are taking their clients' money and moving it from treasuries into stocks. Why? Okay, treasuries are treasuries. They're paying, let's say, 5%. Into stocks. Stocks are not guaranteed. But they believe so much that stocks are going up from here that, and all of the worst is behind us. We've got good news ahead of us. Yeah, it's an election year, but that's already baked into the cake, so to speak. And they see it as a good bet on behalf of their clients to put that money to work in equities. Well, maybe, but what's their exit strategy? What if equities don't do what they thought? Is there a plan to deal with that? Well, he doesn't say. But they say the risk has been removed. The risk has been removed. Wow. So I'm thinking, the first thing that came into my mind was, and of course I wasn't around back then, this is 100 years ago, but in 1930, they came out with a song, Happy Days Are Here Again. We've heard it before. And it became part of a movie, and it actually became part of the campaign theme of FDR in 1932. Happy days are here again. Well, that might have been true in 1929 or in the 1920s, but it wasn't true in 1932. So for the next decade, even though FDR used that for his theme song, it didn't work out that way. And there are a lot of times where, and this is kind of the point he's making, where things seem so wonderful that people are not looking at the other side of the coin. And when you look at equities, is this the time to buy equities? We're invested in equities in our strategies. We have done very well. We've been invested in growth strategies. We've been invested nearly every day this year. We have done very well. I'm pleased about that. But I also know this is not going to go to the moon. And we use an internal indicator in the market to tell us when to get out. And that has not triggered yet. And when it does, we'll get out. And until it doesn't, we'll stay in. So I'm okay with that. But I have a plan to get out. When things get too risky, and they will, I have a plan to get out. And so all I would say to you is, have a plan. Have a plan of whatever that is for you. Have a plan to get out of the market when it's no longer favorable. But it was shocking to me to hear him talk about this Wall Street firm that is saying to their clients, move your money out of treasuries into equities. When you'll see this tomorrow. If you watch my other video that comes out tomorrow, you'll see it. The line on the S&P 500 is slanted straight up. The line on the NASDAQ is slanted even steeper. Everything in equities is pointed up. Is that the time to buy? I mean, it just seems odd to me. You want to buy at a cheaper price, not at a high price. It seems like that's fairly risky. So, but anyway, I think you'll enjoy this. I'm going to play about 3 minutes of a video here from McAlvany, and you can take a listen.
You know, earlier this week, I sat on a call listening to a Wall Street firm. I won't mention the name, but they were extolling the merits of long-term investing. They were imploring the client that I was there to listen in with to put all their remaining cash and treasuries to work now.
In the stock market.
Yeah. And that's in spite of high prices, relatively high valuations. They pointed out, look, we've had a great earnings season, so the valuations have improved. And the argument's always, you can't time the market. You need to have all of the diversification tools in play. And so, of course, the flavor of the month right now is alternatives. And they'd love to see the allocations bigger to private equity and private credit. Get out of your short-term treasuries. You need to pick up the extra 70 to 80 basis point yield in corporate credit. And again, ditch the short-term treasuries. No signs of a slowing economy. The Fed's going to cut rates 3 times this year. There's no concerns with market volatility. I even asked a question about elections, and nope, you'd already see it priced into the markets. So market efficiency dictates that surprises are already priced in, and those were the firm's views.
I'll never forget in 1987 when I came to work here, the stock market, there was only blue sky ahead. Reagan was in office. The Soviet Union was starting to crumble. The stock market price earnings ratio was in the mid-20s, but who cares? It didn't matter because everything was going to go right. And I feel fortunate that that was my first year here working with the family because everyone who was alive at the time remembers the October surprise, the October crash. In a couple of days, the stock market lost between 30 and 40%, depending on what you were owning. It feels like that now because when I came to work here, I remember reading Fortune magazine, and on the cover of Fortune that summer of 87, it said, this time is different. Yeah, price earnings might be high, but this time is different.
It was 2002 that inspired me to come back to work with our family business in the precious metals business. I was working at Morgan Stanley at the time. Barton Biggs wrote an internal memo. He was one of the chief economists, Stephen Roach, Barton Biggs, a couple of other guys, but he wrote this internal memo, and he was describing a derivatives trader who in 1987 came up with an idea, which was to short the equity market. It was the summer, and he laid out his justification for why he thought there was going to be a significant decline in the fall. And he couldn't convince anyone. So he took all of his money and family money, which amounted to about $60,000, not a huge sum, and he shorted the market. And he retired to Sun Valley in 1988. But Biggs was very clear. He said, we thought he was crazy, and we still think he's crazy. Now he's interested in gold. Again, go back to 2002. He's interested in gold, and I think he's still crazy. And then the last line of that missive was, unless we are.
The Fed is saying to inflation, looks like a duck, walks like a duck, quacks like a duck. See, everything is ducky. And when you listen to Chairman Powell, it sounds like that. Thank you for watching. If you have questions or comments, leave them in the comment section below.